Okay, welcome back to chapter 10, and we're doing the last half. So we're continuing with property, plant, and equipment. And the first thing I'll talk about is details of costs of specific assets. So this is what can you capitalize versus expense. So capitalized cost of PP&E includes all expenditures needed to acquire the asset, purchase price net of discounts and rebates, bring it to its location and to a state where it's ready for use, include delivery, site preparation, installation, assembly, professional fees, etc. Also, we have to include discharge obligations associated with the asset's eventual disposal, for example, site restoration. Okay, so if you look at some of the nuclear plants in Ontario, inside the cost of their asset is the discharge obligations. So they're big, they're millions and millions of dollars. They all have to be included as a cost of the asset. And in 316 you'll actually calculate discharge or asset retirement obligations. Now, costs that are not capitalized, so they're going to be expensed: initial operating losses, training employees, reorganizing your operations, and general overhead costs, opening a new facility, introducing a new product, operating in a new location. Okay, so now let's go to measurement after acquisition. There's three ways. So once we've purchased an asset and we buy it at fair value, or it might be carrying value, depending on the situation, companies have to decide how to account for them yearly. There are three models, and the same method must be used for all assets of the same type or class. Now remember that CRA and its rules about cap cost allowance and which class falls in is completely different, okay? But same class or grouping. So all your buildings should be the same way. All your fleet of vehicles should be done the same way. All your manufacturing equipment, okay? So there's the cost. This is the model you're most familiar with. You record the asset at cost and record depreciation yearly. Also, you check for impairment, as we saw in another chapter. There's the revaluation model, new with IFRS. It lets you put your assets at fair value on the date you revalue, less any subsequent accumulated depreciation or impairment loss. So this lets you revalue to fair value, which was totally new. Canada, in ASPE, that's been going on before we added on IFRS. This is totally new. Nothing could ever be marked to fair value, whereas IFRS a lot more of marking to fair value, trying to increase relevance while keeping reliability still under control, or representational faithfulness, from chapter 2. Now the fair value model, with this model, assets are recorded at fair value, changes are reported in net income, and there's no depreciation. So we're going to go through all of these. This last one is for investment property only. Now, IFRS uses all three. You can use all three. ASPE, you can only use the cost model. So the only choice for ASPE is the cost model. Now, under IFRS, investment property can use either the cost model or the fair value. Other property, plant, and equipment can use cost or revaluation. Okay? So you already know the cost model. We're going to go through revaluation and fair value models. Love the fair value model. It's so easy. But the revaluation, let's do that one first. It's a little bit trickier. Okay, so under the revaluation model, The increases or decreases in fair value get charged to a revaluation surplus account, which is recognized through EI on the income statement. Okay, so we are dealing with OCI. So that makes it two things that go into OCI. When we are dealing with investments and we mark the investments as fair value through OCI, let's go through there. Revaluation model is the other. Recognized through OCI in the income statement. Now, this account can never have a debit balance. So anytime you're in that position, you have to charge the difference to net income loss. And we're going to do an example of this, so don't worry. Now, the revaluation surplus account can either get closed to retained earnings every year, or left alone and closed to retained earnings when the asset is sold or retired. Revaluation gains and losses do not get recycled through net income. So that just means it goes to directly to retained earnings. Now, the other thing we have to deal with is the accumulated depreciation account. We can either adjust accumulated depreciation proportionally, and just FYI, that's in Appendix 9B, I believe, when the carrying value is changed, or we can transfer the balance of accumulated depreciation to the asset each time it's revalued. Okay? So this one's an easier one, but I'm going to show you both methods. Because interestingly, you do the same kind of thing in 410, Advanced Financial, when you're doing a consolidation and you have to get rid of the accumulated depreciation to mark your asset up. So this one's easier, and in 410, you'll get method of adjusting accumulated depreciation. Just kind of to give you, I know it's going to be in a whole year, but just so you have that. Okay, so we're going to do an example now. And just before I change this then, transfer the balance of accumulated to the asset. That means zero out accumulated depreciation. And again, you guys, I know for this term and next term, your exams are open book because of COVID. Everybody's at home and we can't monitor and so on. So you may be tempted to, hang on a sec. You may be tempted to not memorize things and not prep as deeply. I highly encourage you guys, exams this year and next semester, this semester, next semester, as if you are writing them closed book. The main reason being the time. The second thing is next year, hopefully, let's cross our fingers, knock on wood, if we open classes up again in person, you're going to have this memorized. And have you memorize it? Because when you get to CPA, you've got to know it all. Okay, the only thing you get to access during your exams is the CPA handbook, which doesn't give you the detailed entries or anything. It just tells you what you should do, like this. Under this, you do this, you do this. Okay, but it does it in more legal language rather. Anyway, so try and study as much as you can as if it was a closed book exam. Okay, so we're going to go on with the revaluation model. So this is like, let's say every 2 years or so, you revalue your assets to fair value. Okay, so you do it in a pattern. You don't do it costly to figure out what the fair value is. Okay, let's go on to page 6 and of revaluation. So, January 2017, CC purchases a building for $100,000, 25-year life, and no residual value. It revalues the class or the group every 3 years and uses straight line depreciation. It revalues this group at its December 31st year, and now it tells you the fair values. December 31st, 2015. Whoops, I think I forgot to change that date. And that should be 2018. Did I add 3 on? Oh, 2019. And 2022. Sorry about that. Can you change that 2015 to 2019? I missed that. And I want, revaluation surplus is closed or reclassified to retained earnings when the asset is disposed of. And as we said, it didn't have to. You could have done that every year, or you can wait till the end. Record the entries in 2019, 2022 to clear accumulated depreciation before the revaluation, and revaluing use the asset adjustment method. That's just revaluation. Another word for it. And so clearing accumulated depreciation is what we call the net method. So there we go. Okay, so we don't care about the purchase, we want the entry in 2019. So December 31st, 2019. First thing we have to do is clear out the accumulated depreciation and move it to the asset. So that's the first thing we do. So what is our depreciation? So we've had 2017, 2018, and 2019. So that's 3 years. So we know it's 3 years times straight line cost 100,000 over 25 years times 3 is going to be 12,000 for the 3 years. So we would have done 3 depreciation expense entries. Okay? They have all gone into accumulated depreciation. So we have to close accumulated depreciation. And how do we do that? Debit or credit accumulated? We debit, because it's a credit balance, debit accumulated depreciation for 12,000. And the building, so we're reducing the amount of the building by 12,000. Okay, so I'm going to keep track over here of the building account. So we started with 100,000. Now we just took out 12,000, which gives us a balance of 88,000. Everybody good? Okay. Now we need to revalue the building. So step 2 is revalue building. So at the end of December 2019, balance in the building is 90,000. So we have to make the balance building go to 90,000. So that's the new fair value. So how are we going to make 88 go to 90? We're going to debit it by 2,000. So we debit our building for 2,000, which was the 90 minus the 88. And we credit revaluation surplus OCI for 2,000. Now, I'm also going to keep track of revaluation surplus OCI. And we started with 0. So the first thing that goes in is a credit of 2,000. Everybody good with that? Okay. So we revalued our building the first year. So now we get to December 31st, 2022. So December 31st, 2022. So we know the fair value is 75,000.